So I'm very financially literate, everyone, but from a technical perspective, I am woefully tech illiterate. Okay, so
just a quick note for everyone: when you have questions, please use the Q&A section, not the chat, just so to make life easier for myself and Luke. Thank you very much.
Okay, so I've got two questions that I can see in front of me. I'm not an expat at present. Does this seminar apply to a UK citizen in the UK? Well, while this does have some focus on expats and expats' needs and wants, the general core concepts you're going to learn are useful and pretty much transferable to anyone from anywhere. There's a few points which you will be able to recognize as not being explicitly relevant to your personal circumstances within the webinar, but on the whole, it should be very helpful. Are you familiar between this US situation regarding pension transfer between the Netherlands and the US? I am, and I can tell you that you don't have any options, really. I do talk about pension transfers later on in the webinar, but essentially, it's very hard to do between countries which really allow it, and it's between the. You can transfer, for example, state pensions across the EU because there's essentially a bilateral agreement between all of those countries that will allow you to do it. When it comes to the US, EU, there's not really many options available. Will I share this presentation with the participants? I will. Yes, I will. There's a lot of maths. Well, there's not a lot of maths, don't get worried, but there's a bit of maths in here, so it is useful to be able to read the presentation notes at your leisure. Will the webinar be recorded? I have another meeting at 7:30. The webinar wasn't going to be recorded until you said that, and I remembered that I should record these things, so that's going to start right now, guys. Whoever gave... Renee, thank you so much for saying that, because otherwise that really wouldn't have happened. There we go. So everyone watching, this will be recorded. Am I aware of any pension transfers to Netherlands to India? Just regards to pension transfers, I will cover that later on, but just to answer that question, don't think you can do it. I've never heard of being able to do it. It's not something I would even attempt to try because I don't think it's available. The main ways that you can really transfer pensions is under, in the EU, it's under two basic bits of law. One allows you to transfer state pensions, and one is called the Freedom of Capital Transfers or Capital Movement legislation introduced in 2006, which relates to private pensions. But even with private pensions in the EU and there being EU legislation around it, it's still nigh on impossible to do in a lot of circumstances, unless you're Irish or have Irish pensions. And it was easy to do when you had UK pensions back when the UK was still part of the EU, those better days. I cannot see anything. Luke's screen is black. Is that the case for everyone?
I see you. I see the Black Tower retire in style. There's a lot of black in it, but I see the letters. Anyone else in the chat, let us know.
Okay, well. Okay, Karen, I'm just going to quickly send you some links that we can use.
Okay, thanks, Luke.
Okay, just because I know most people watching here, well, everyone watching right now is in Zoom, but part of the feedback I've got, particularly from some close friends of mine, is that Zoom, a lot of people don't like using Zoom and won't come. So just to try and maximize the number of people who are eyes on me, we're going to just send a few sharing stream links so that everyone at home has a chance to watch it. Okay. And yeah, we will start the minute I send out this email. Okay. Also, Karen, can I ask you a massive favor? Can you put the registration links in those streams as well? Okay, right. Sorry for that delay. This is my first presentation of the new year, and I think it unfortunately shows quite well, or badly. So let's get started with Retire in Style. So this is going to be the basic overview of this presentation. And just before we get started, really what this presentation is all about is I'm going to try and teach you guys how to create your own retirement plan, from starting with creating your retirement goals all the way through to choosing where to invest it and how to manage it. But we're going to start with an introduction to Blacktown. Blacktown is the firm I represent, and I, of course, have to give you a little bit of background about them. Then we are going to cover a subject which I talk about non-stop in my own personal life, which is why retirement planning is so important. Followed by the really 3 steps we're going to cover here today. The first is creating your retirement goals and understanding what information that you need to know in order to be able to successfully create a retirement plan from that, and translating those goals into real achievable financial targets. Then we're going to look at actually creating a retirement plan to meet that financial target that we set in step 1. And then step 3, we are going to be looking how to manage our retirement assets. For example, do we want to invest them through a pension scheme? Do we want to look at a local tax relief investment scheme? Or potentially, do we want to look at none of those things and go for a more flexible approach? We're going to talk a bit about double taxation agreements and how to manage risk and really when to start. And lastly, we'll finish with a Q&A session. Now, if anyone wants to ask any questions at any point, please put that in the Q&A box and I will get to it at the end. Please don't raise your hands because honestly, I get distracted, it disrupts my flow, and I stumble over my words. And when I look back at the recordings, it haunts me. So without any further ado, let's crack on. So who are Blacktown Financial Management? Well, we are independent wealth managers who have been operating across the globe for over 35 years. We are fully regulated and authorized, and we deal with both individual clients and corporate clients. Why choose Blacktown? Well, apart from our sterling reputation in the market, I really think that reputation has been built upon a focus on strong client advisor relationships and the fact we don't treat investment as a one-size-fits-all approach. We work with our clients to create tailor-made bespoke portfolios to fit their needs and their circumstances. Here's a quick overview of our services. And now is the point I'd just like to mention that if anyone wants a complimentary financial consultation, Blacktown is offering it to everyone who has attended or even watched this event on the replay. Karen should have a link in the chat available for you to click through and leave your details, and I'll be in touch over the coming days. Now, we offer a great deal of different services, but of course, we do offer the one we're going to talk about today, and that's retirement planning. I highly encourage everyone to click the link. I am very proud of the work we do, and it doesn't cost you anything, so don't really lose much. Now, why is retirement planning so important? Well, retirement planning is probably, weirdly, one of the things I'm most passionate about as an individual, and I think this started ever since I realized that it was going to hit my generation the hardest. This is because, as individuals, we're all living longer than we've ever lived before. If we think about retirement planning in its traditional sense, really what we're thinking about is pensions. So government pensions, employer-backed pensions, and a few people would have private pensions. Now, when pensions were first introduced, not everyone really reached retirement planning. To be brutally honest, we all had too much war at that point, so a lot of us weren't reaching our later years. And those who weren't living nearly as long as we are living today. And that life expectancy has continued to rise throughout the years. Even if we only go back 50 years, we can see that upon reaching 60, there's been an increase of 10 years of the total number of years that you can expect to live. So that's an increase. So your retirement age has shot up from average, so you're yeah. So everyone's living longer than before. And we're having more people reach retirement age than before. We are all living in an aging population. And what that's doing is it's putting pressure on these past and, quite frankly, outdated systems of retirement planning, like the government pensions and the employer pensions. Governments are struggling to find out how they're going to fund these pension plans or state pensions now that everyone's living longer and needs more money. And they've got three kind of solutions to this, and none of them are particularly nice. Solution one is they can raise taxes and pay out pensions by increasing the general tax rate. Solution two is they can reduce retirement benefits and pay everyone less pension, so everyone has a lower standard of living than we would have been expecting. And option three is they can raise the retirement age so they pay out a lower number of years in retirement. Now, across Europe, we've really seen governments opt for option three, which is they raise the retirement age. But this is quite frankly unsustainable. Otherwise, you're going to have people who are in their 70s and 80s still in full-time work in 30 years. And companies don't have this benefit. They can only choose option two, which is to reduce benefits. And we've seen this happen already. In the past, we had very generous pension schemes offered by companies, which were known as final salaries. And now we have less generous pension schemes, which are known as money purchase schemes. And the difference is that final salaries were a guaranteed source of income for the life of your pension, whereas money purchase schemes, they just invest a set amount of money and the risks fall on yourself. With this increased pressure and increased burden on these past systems, relying on them to support yourself in retirement, I'm not going to say it's a terrible idea, but it is a pretty terrible idea if we're being honest with ourselves. And putting your eggs in the government's going to solve this basket isn't it's not a route I would take. And the trouble is, this is just one side of the coin, because on the other side of the coin, we're all having less kids. These are the birth rates per 1,000 people for the EU. And we've almost halved the birth rate in the last 50 years. So that means not only are we all getting older and there's going to be more of us living longer in retirement, we're going to have less people who are working, or less people in the working population to support us when we're in our retirement. So that means we're going to have essentially the most amount of people we've ever had living as long as possible, and have a less amount of people supporting those people. And the working population relative to the retired population is going to probably be the most imbalanced we've ever seen, and are likely to ever see for many generations. So this is why I feel that for at least people who are between the ages of 20 to 40, or at least 20 to 50, it's essential that you start learning how to secure your own retirement. And if you haven't started yet, please click the link. Now, here's a few cherry-picked headlines from over the years of why retirement planning is so important. And really, not saving enough is the biggest regret for retirees, is number one. And this is now. This is before these low birth rates come in and before we're retiring, and it's getting worse every year. So now that doom and glooms aside, let's actually work on how to get a solution in place. So step one is all about creating your own retirement goals. Now, if you guys want at home, you can write these down and essentially calculate alongside me. But just so everyone understands, throughout this presentation, I will be using my own example of how to create a retirement plan. So whenever I speak to people, I ask them three main questions. I ask them where they want to retire, what age they want to retire, and in today's terms, or today's income level, how much income would you like per year for retirement? Now, these goals themselves are great. It's important to know where you want to retire because you can start packing. It's important to understand how much you want to receive on a yearly basis and when you want to retire. It's quite hard to turn those into a retirement goal or a target sum or a figure that you need to hit in order to achieve these goals. But that's exactly what we're going to do. And it's actually a lot easier than I've just said. And essentially what we're going to be trying to do here is we're trying to be building up enough wealth so that we can live off the interest in retirement. Now, I'm not sure how many of you have heard of the 4% rule. The 4% rule is a rule coined by an advisor in the States. And the idea behind it is essentially that when you get to retirement, you can afford or you can take out 4% of your total retirement portfolio and adjust it for inflation each year. And you would never run out of money. So really the principle is to have enough money invested that the portfolio on average grows by more than 4%. So every time you're taking out that 4%, you're really just taking out the interest. I'm not sure if this is blocking it, but I'm going to move it nonetheless. So what we then need to do is we need to take that target retirement income. Remember, that's the figure that you would like to retire on in today's terms, and divide it by 4% to give the total target sum, which is the amount of money that we'd need to have in our retirement portfolio in order to retire today. So I'm going to give you a very, very easy example, which is I want to, so using my example, sorry, the clicker is not working. Okay. So in my example scenario, I want to retire on an income of 40,000 euros per year in 30 years time in the south of France. I picked the south of France because I'm incredibly unimaginative and pretty stereotypical Brit. Now, using that equation we had before, we're going to divide 40,000 by 4% to understand how much we'd need to have today in order to retire and take out 4% from that every year, adjust it from inflation to get 40,000 a year. And that figure is 1 million euros. So that's great. But we're not planning on retiring today. And the trick is we have to now think about inflation. Now, for those of you who don't know, inflation is really the idea that every single year, everything gets a little bit more expensive. Inflation is really the decrease in purchasing power of currency. Now, for the last 10 years, it's been fairly low up until last year, where it got very high. And in case none of you know this, inflation in the Eurozone is around 5% right now. Inflation in the UK is just a little bit higher than that. And the US figures just came in at 7% today. So what that means to you guys sitting at home is that unless you've had a pay rise last year, you've had a pay cut of around 5%, 7% in the US. And in order to buy the same amount of goods and services that 40,000 euros could buy me today, I need to understand how much inflation is going to affect that, or because 40,000 in 30 years' time isn't going to buy the same amount of goods. So I need to adjust that figure for inflation. Now, I'm going to recommend using a figure of 3% to calculate the inflation rate. Why 3% if inflation is currently 5%? Well, in the past, I've actually been accused of being too conservative with my estimates and saying that 3% is way too high to be using, because for the last 10 years, it's been knocking around 1 to 2% per year. I think for a long-term estimate, 3% is a rather conservative value of inflation. And if the 5% or 7% inflation rates that we've been seeing in the last year carry on the way they've been going, well, frankly, we should have riots in the streets. So I don't see that continuing. Well, I hope it doesn't. Now, to calculate inflation over a long period of time, I do have a calculation, and I do have a little formula, which I'm about to show you. But for anyone who doesn't like maths, that's absolutely fine. If you Google interest rate calculator or compound interest calculator online, there's tons of free, easy online tools that will do all of this for you. But if you like doing the maths like me, let's have a look. So just to go through this very quickly, T relates to the amount of times that we want to compound for inflation. In my example, remember, I want to retire in 30 years time, so that will be 30. N is the number of times interest is calculated per year. We're just going to use it 1, so that can just go down to that. We can just replace N with 1. This is how the formula breaks down. The interest rate is the inflation rate we're using. So in our case, because we are planning on using 3% as the inflation rate, that can go to 0.3. And the principal, or the present value, remember, that's the amount of money that we want to have saved in order to generate 40,000 a year, which is $1 million. So really, we just plug all those data points in, goes to this. So if you remember, we've got $1 million, which is our target retirement sum. Our interest rate is our inflation rate, and our time is 30 years. Do the mathematics. I'm not going to take you through how to do that. And it comes out to 2.427 million. This means in order to generate 40,000 euros worth of goods and services today in 30 years' time, we need, at 4% a year, we need to have 2.427 million euros invested in 30 years' time. So inflation is something which does catch a lot of people out. It's not really something you notice year to year. 2 to 3% a year doesn't really seem to be making much of a difference, but 30 years down the line, it's over doubled the amount of money you need. And this is our future target retirement sum. Okay, and this is now the figure that I need to hit in order to achieve my target retirement goals I set at the start of this step. Now, if you've been calculating at home, you can probably see future target retirement sum, maybe similar, maybe a lot higher if you're a lot more adventurous or optimistic than me. So just remember, though, that if you don't like doing the maths, that's absolutely fine. Here's one example of one of the thousands of different compound interest calculators that you will have at your disposal. So just a quick summary of everything we've covered in this section. We establish our desired retirement age and level of income. We calculate the total size investment required to generate our retired income through interest or growth, and then we account for inflation to give us our target retirement sum. I hope everyone's keeping up so far. And if not, that's fine. I'm happy to go through it with you at the end. So step 2, creating your retirement plan. So now we've got that target retirement sum figure, we should be looking at how to create a plan to reach that. So the first thing we need to do is we should establish a benchmark rate of return. Now, this is the level of return that we would expect to receive on an annual basis from our investments. Now, this is entirely down to you or the individual. And some people like to get very over optimistic with it. And it means that it looks great. It looks like you'll always hit your retirement. But I tend to go quite conservative. Now, I would recommend benchmarking an investment rate of return between 7 to 10% per annum. And I'm in this scenario, I'm going to be using 7%. Now, the reason I've included 10% is because that's pretty much the average rate of return of the S&P 500, which is the largest 500 stocks in America. Now, if anyone's just been new to investing over the last 10 years or hasn't really looked at investing returns over the last 100 years, this might seem a bit low, but I promise you it's actually not. We've just had an incredibly good positive set of market conditions over the last 10 years. And we've seen lots and lots of growth in the market, particularly among tech stocks. But I would always say that it's better to plan for failure than planning for success. And well, not plan for failure, but be as conservative as possible, because essentially there are two different problems you can run into. You can either overplan and have too much money in retirement to meet your retirement goals, not a problem. But if you over-exaggerate your growth and don't achieve that and miss your retirement goals, not having enough money in retirement is a big problem, because it's kind of you don't really have many options to then increase that when you reach there. You won't be working anymore. And you're kind of on what you, well, you're kind of left with what you got so far. So now it's important to calculate our retirement shortfall. And our retirement shortfall is a difference between what we need to retire and what we are likely to have in today's circumstances from our own net worth or our own investments. And this is basically, a lot of you are going to have pensions or current investments. So for example, yeah, so you might have current pensions to bank, or you might have investments that you know you're going to be putting towards retirement. And now we should calculate the expected portfolio value of those when you reach retirement using our benchmark rate of return, and then subtract that from our target retirement sum to see what the difference is. And then that difference is what we're going to use to build a retirement plan around. So just to put that in a bit of perspective, remember our current plan so far, we've got, I want to retire on 40,000 a year, 30 years time in the south of France. Well, let's suppose that I have 60,000 euros in pensions and I've got another 40,000 in current investments. And because I'm using that towards my retirement, which is 30 years away, I would then need to compound, I would then need to calculate how much that's going to be worth in 30 years time at a return of 7% per year. Now, I know there's a lot of maths in this, but the maths will stop in around 3 slides time. So, or maybe 4. So if anyone's getting bogged down by the maths, don't worry, it'll be over soon. Now, using the same compound interest calculation that we used in step 1, we can see that our present value is 100,000, because that's 60,000 plus 40,000. And then we're going to times it by our benchmark rate of return, which is 1.07 to the power of 30. So we're going to times it by that 30 times to see that the future value comes out to 761,225. So now what we need to do to find out our retirement shortfall is to take our target retirement sum, remember that's the figure we need to achieve our target retirement goals, and take away the expected future value of our current assets to see what's left over. So in the scenario I've been doing so far, the original retirement target was 2.4 million. Remember that will give me 40,000 euros a year's worth of investment at 4% compounded for inflation. So I'm taking our expected portfolio value, which is 761,000 away from that. And that gives me 1.666 million. So that 1.66 million, that's what I don't expect to have at retirement if I do nothing now. If I don't change anything, that will be the difference. So now that we've understood the difference between where we are now and where we need to be, we need to put into a plan of how to achieve that. Now, the most common way to save is to do so in monthly installments. And calculating compound interest in monthly installments needs a new and final formula to do so. So I'm actually not going to go through this because it could take me a while. What I will say is, unless you're a huge nerd like myself who loves maths, for these calculations, I would really recommend using a compound interest calculator, like this one linked here. But assuming that we've either used a formula or a website, with our current example, 1.66 million, we can find the monthly investment required to achieve our desired sum over 30 years at 7% return a year is roughly 1,358 euros a month. And what this would represent in total investment terms is a total investment of around 488,880 and a total profit of 1.177 million. The trouble with this is that not everyone can afford to make that type of investment. So what do you do if you're in a situation where you don't think in present circumstances you can afford to make this level of financial commitment over the long term? Well, you normally have around 3 different options available to you. You can do what you can now and increase your investment in the future. Typically, as we go through our working lives, our income is the highest towards the end and lowest towards the start. So quite naturally, you can expect to make more in the future. Option 2 is that you can reduce your desired income level. And really, this is just saying that I will take a lower standard quality of life in retirement than I had previously planned. And sometimes that is a decision people have to make. Option 3 is increase the retirement age. Now, options 1 and 2 here, pretty self-evident, the consequences to them. But I just want to take a few seconds showing you what happens, for example, in the scenario I've been using, if you were to increase your retirement age by just 5 years. So I'm going to go through the maths very, very fast because I don't think anyone's particularly keen on doing them, but I'll get to the conclusion. So the new retirement target is now compounded for 35 years. So remember that million we need to get 40,000 today's terms, that jumps from 2.4 million to 2.8 million. Our current assets was that 100 grand we had between 60K in pension and 40K in investments. We compound that by 7% for 35 years. That takes us up to 1,067,000. That means our new shortfall is 1.746 million. That is still higher than the 1.66 million we had, but now we have to look at the monthly investment following that. So if we now invest on a monthly basis over 35 years to achieve this new, admittedly slightly higher target, the monthly investment actually falls to 991 euros as opposed to that 1,358. And this represents actually a total investment over that 35-year period of 416,220. So if you're remembering correctly, before the total investment was around 488,000. So by increasing it for 5 years, although you're achieving more growth and more profit, more total investment at the end, you're actually reducing the amount of investment you have to make, not just on a monthly basis, but on a total basis as well. And the total profit, of course, as well, increases to 1.379 million. Now, of course, it sounds great when you look at the numbers, but this means you've got to work for 5 more years. And not everyone, myself included, really might find that an optimal solution. Just know that this is an option. Really, the longer you have to invest, the longer you have to have your retirement plan grow, the easier it is to retire and to build it up into something quite significant. I've always said that time in investment terms tends to be your most valuable asset. So just to summarize this section, first thing we need to do is we need to create or establish a benchmark rate of return. That's the figure that we would expect to make on a yearly basis from our investments. We would then calculate current assets expected value at retirement. So these are the assets that we already have invested, which we were going to use for retirement planning. Should note, if you're not going to use these for your retirement plan, they are not relevant. If you're saving money for a deposit on a house, that's not going to go into your retirement plan, and you shouldn't include it in these calculations. Calculate our retirement shortfall. That's just the difference between how much we need to get to our retirement targets and how much we're likely to have in that calculate our current assets expected value at retirement range. So finding out the difference, and that's what we need to make up. And assuming we don't have any lump sums or money coming from additional sources, we then look towards how much additional monthly investment is required to overcome that shortfall. So this brings us on to step 3. That's the end of the maths, or at least the complicated maths. Let's get on with the fun bits. So now we've got our investment plan. We know how much we need to invest, what we're trying to achieve, how much we're saving on a monthly basis, for how long. Now comes time for the fun decisions. Where are we going to invest that? Are we going to look towards pensions? Are we going to look towards local tax-efficient saving schemes? Or are we just going to look towards non-tax relieved international schemes? Well, pensions are fabulous for really one reason only, and that's tax efficiency. But that is a fabulous thing to have. Contributions from untaxed income can be very tax efficient. Downsides to them is you do have to pay that tax. When you take money out of a pension, that is an income event, and you'll be taxed at income tax as income tax. So you still have to pay tax on pension investments, but because you're not paying it on the way in, and because when you are retired, you tend to be in a lower tax rate because you're not making as much as you used to. The tax burden seems to be significantly lower. Plus, you're not getting taxed on the growth, which you may not be depending on which country you're based in as it results. But typically, in a lot of countries, you are. You also have possible language barriers, possible restrictions on investment. For example, company pension schemes tend to be very restrictive in where you can put your money. Various different countries have different laws on what type of investments you can make. For example, in the UK, you can't purchase anything which isn't in sterling. And you can have restrictions on withdrawing assets. I mentioned the UK. The UK is actually quite good for this. UK pension schemes, you can take out money pretty much kind of like a bank when you get to retirement age. If you've got 150 grand in your bank and you want to take out 25 to buy a new car, you can do that. Other countries like the Netherlands, which is where I'm based, or was based, don't have that luxury. In the Netherlands, when you have a pension scheme, that's got to provide an income for life. So if you've got 20 grand in your pension scheme, you can't take out that 20 grand when you hit retirement age. You've got to convert that into an annuity or income paying solution, which typically probably 20 grand will pay you 400 euros a year, or maybe 600 euros a year if you're lucky. Which is good because it means that you will always have income, but it's bad because it's very inflexible. But the main thing when it comes to talking about pensions for expats is this. It's very useful to have all your money, or at least your money fairly consolidated. You don't want to have 1,000 different investment schemes all around the world. Now, the problem with pensions is that there's no European pension, which means it works everywhere in Europe. Dutch pensions will only, you can only get tax relief on pensions on Dutch pensions if you are tax resident in the Netherlands. You can only get tax relief on German pensions if you're tax resident in Germany. So just imagine this, you're based in the Netherlands and you start a new pension scheme. And you start putting your money in there on a weekly, monthly basis. And then you get a fantastic new job offer. It's across the border in Belgium, maybe it's in Germany. It's just not in the Netherlands. Well, then you move and you've got to stop paying money into your Dutch account. Because the only benefit you get from pension schemes, remember, is that tax relief. which they can now no longer apply because the German government isn't going to give you tax relief investing in a non-German pension. So what that means is that you then have money stuck in the Netherlands. You can't move it out of the Netherlands because it's a pension. And if you want to get that same tax relief, well, you're probably in Germany thinking, well, I'll start a new pension. And then let's say you move again and again. I work in expatriate financial advice, so I know that this is a common story amongst expats, and we tend to move around quite a lot. Last 12 years, I've lived in 4 different countries. And the worst case scenario, well, not the worst case scenario, but a bad case scenario for you is getting to retirement age and realizing that you want to start taking down money from the pensions. But you've got 6 or 7 or 10 or 12 different pensions in different countries, which have different laws and how you can take them out, how they get taxed, can be in all sorts of different languages, be in all sorts of different currencies, and have all sorts of different restrictions, which you don't understand. So if you're an expat who likes to move around a lot, I'm not saying don't invest in pensions, I'm just saying maybe really, really think about it and perhaps not. Now we come on to local tax efficient schemes. Now, local tax efficient schemes are essentially tax efficient schemes which aren't pensions. And some countries have these, some countries don't have them. I'm going to be very generalistic on here because we have lots of different people from lots of different countries here. But by and large, the benefits are that they're tax efficient. Again, like pensions. The downsides are that they tend to have a lock-in period. So this is a minimum investment time. It's not necessarily the same as the retirement age where you can only get access to it at a certain age, but you might have to have the investment stay in the same place and not take money out for around 10 years, 12 years, 8 years, depends on the country. They can have high minimum initial investment amounts. So you can't just start with 100 or 200 a month. You've got to start with 50K, 100K. I've seen as high as 500,000 before. And they tend to be more expensive. This is because they're offering tax relief and a bit more flexibility than a pension. So they're going to be more expensive. And they can have multitudes of different restrictions. And really, your access to these types of schemes is going to depend on how much money you've got to invest in them because of the minimum initial investments, but mostly just where you live. For example, these really aren't that available to people who live in the Netherlands. If you live in Portugal, tons. And the funny thing about the Netherlands, that's mostly because the Netherlands don't really recognize trusts. And that's the major way you kind of put these things together. But if you are going to go for either pensions or local tax relief investment schemes, the one thing that you all should be looking at is double taxation agreements. And really, this is just an agreement to make sure that you don't get taxed on the same income in 2 different countries. So this is essentially because when you're holding in a tax relieved investment scheme like a pension, they can be paid out net of tax. And therefore, for example, if you take out money from a Dutch pension, you could be paying money to the Dutch government directly. And then when you're living in another country, that income's coming into your bank account and they can see that income as, oh, this is income. This is something we can tax. And an agreement between those countries in the form of a double taxation agreement is the agreement that you will not be taxed twice on that. Now, if you're based in the EU, probably don't need to worry about these if your money is also in another EU country. By and large, the EU has double taxation agreements with everyone between them. This is more of a problem if you are investing, for example, in more exotic locations, or you are moving to more exotic locations, or you're retiring in more exotic locations. For example, parts of Africa, parts of South America don't tend to have as many of these agreements in place. Regardless, even with your pensions, it's worth giving a check. Now, if you don't want to go down the tax relief route, you can look towards international investment schemes. And this is something which I tend to recommend a lot of expats go down, just because your money doesn't tend to get trapped anywhere. You don't have to worry about double taxation agreements. And it's all a lot more simple. And you can hold all your money in the same place. And plus, although we all like the idea that we've got this retirement scheme, we can put our money in the retirement scheme, we're not going to touch it till we get to retirement age. The unfortunate fact is that sometimes circumstances change and we need fast access to cash. Some of my clients, for example, have had family emergencies where they need to dip into their retirement saving schemes in order to, in the most general way possible, help their families out of an unexpected event. Now, I normally encourage them to have emergency funds set up in place to have that, but when those emergency funds don't meet a large additional expense that the family has to bear, having your investments outside a pension or outside a local tax relief investment scheme does give you the flexibility that you do have that option. On top of that, tend to be the cheapest options. You don't have to go, the people providing them don't have to abide by these very rigid and complicated tax laws. So there's less administrative work to set them up. They are internationally portable, meaning you don't have that problem that if you start one in one country and move to the other country, you might have to leave it behind and start a new one. You can start one in Thailand, move to the US, well, the US might move to the US, move to Canada, move to Europe, Africa non-stop, and you can have your money in the same place all the time and you don't have to worry about it. But just a note on that, of course, you're not getting the tax relief, and tax relief is really, really nice. So it is always going to be a question of tax efficiency versus flexibility. For expats, I tend to favor on the side of flexibility just because our lives can be a bit chaotic and we do tend to move around a bit. Now, what can you do with all your pensions? Because if we have been moving around a bit, we've moved to a few different countries around Europe, we can have accumulated quite a few different pension rates. Now, the good news is if you have European state pensions and let's say you've worked in Germany for 3 years, you've worked in Italy for 12, France for another 13, Portugal and Spain for 5 years apiece. Individually, those pensions, or at least a lot of them, aren't going to give you any full pension because they have minimum amounts of years that you need to have contributed in order to be able to receive a pension at retirement age. However, because of a pension sharing agreement or a pension merging agreement, whatever you want to call it, in the EU, when you retire, you are able to merge all of those qualifying years into one state pension. And the way you do this is you apply to the local pension authority where you're living or you last worked at retirement age and tell them this is where I've all lived. And then it's their responsibility to do all that work for you. This isn't something you can really plan for now. This is something you have to do at retirement. And I always get asked this question about the UK, so I'm just going to cover it before the Q&A section. If you have qualifying years in the UK state pension, you can merge these with the expectation is that you can merge these with these other EU pensions, so long as those years were before Brexit was initiated. Please don't raise your hands, I get very distracted. I said this at the beginning. So if you do have UK state pensions, the expectation is that when you come to retirement, if you include those in, when talking to the EU pension authority, where you are living or last worked, they will include those in your qualifying years. An alternative, though, is if you've got enough UK state pension years, you can also just continue to contribute to them as in the form of voluntary contributions, which weirdly is very, very cost efficient. You actually make back the amount of money that you invest through voluntary contributions in the UK state pensions in around 9 months of retirement. If anyone's got UK state pensions and you click the link, just put a note on that in your form and I'll be in touch to explain that. So that's state pensions. What can we do about private pensions? Well, some private pensions can be merged together quite easily. So pensions in the United Kingdom and Ireland can be combined into what's known as self-invested personal pension schemes, or SIPs, or qualifying recognized overseas pension schemes, or QROPs, which allow them to be moved to the EU, can be quite tax efficient and also allow you to hold your investments in euros. But unfortunately, this is the minority of pensions. Most worldwide private pensions are quite restrictive and don't really allow that consolidation. So it's not really a solution here, unfortunately. So just a quick note on how to manage risk throughout the length of your retirement plan. When you're young, you can really take a lot more risk with your retirement savings than when you're older. Investment risk, really, it's not risk in the general sense. When we talk about investment risk, we're talking about the level of fluctuation in price or value of your investments in the short to medium term. So as we increase risk of an asset, the price goes up and down in a much more bigger manner. But the counterpoint to that is, as we increase risk in our portfolio, we also increase the expected long-term return. Now, as we're not touching these investments for 20, 30, 10 years, whatever it's going to be, that up and down fluctuation in price doesn't really affect us, because if we're not spending it, it doesn't matter. But the fact that it's giving us increased overall long-term growth, that does matter, and that's something we want. And volatility is really the cost for growth. But if volatility doesn't affect us because we're not touching the money for 30 years, then it's not really a cost. So the higher risk you really put in your earlier years, the more growth you're likely to see towards retirement. However, when we get closer to retirement, that volatility, that really starts to matter. Because if you get to retirement and you're taking 4% out a year, but your portfolio flies up and down 20%, that 4% can massively change on a whim. So as we get closer and closer to our expected retirement date or our target retirement age, that's the time where we're going to start reducing the risk in our portfolio and allow our growth to be far more predictable, admittedly at the cost of growth. So just to give you an example here, this is the cumulative index return of the MSCI World Emerging Markets and Investable Markets Index. Really, this kind of covers all markets in the world here. As we can see, that this is a large spike which fell down on March 2020. If anyone remembers, that's when COVID really started becoming a worldwide phenomenon. And I just want you to imagine the difference between 4% at the top of that and 4% at the bottom. So if you would be invested 100% at stocks at that point and you just went into retirement, then that could be a very disadvantageous situation. Luckily, the growth, everything bounced back and tech stocks led the way to new heights. But that's not always going to be the case. And I think this is one of our last slides. So when to start? Well, the earlier you start, the less you really have to invest in the same goals. So compounding works to your advantage, and time is your biggest asset when it comes to retirement. Now, just to put this in some perspectives, let's assume that our retirement shortfall is €1 million. I'm going to show you the difference in how much you have to invest on a monthly basis, depending on how many years you give yourself to invest towards that. So if you have a retirement shortfall of €1 million at 7% growth, remember that's our conservative benchmark rate of return, that will either cost you €815 per month over 30 years. And then it just goes up. So it goes up to 1,200 over 25, 1,900 over 20, 3,100 over 15, and 5,745 over 10 years. Really, every 10 years that you leave it before you start your investment plan or your retirement plan, you will double the amount of money you have to invest on a monthly basis. And that's at 7% growth. If you increase the growth rate, that figure, it more than doubles, essentially. So here's key points, just kind of cover everything that we've spoken about today. Understand your goals, convert those goals into financial targets, then find your retirement shortfall, create a plan to meet that shortfall, understand where to invest. If you can, merge pensions, especially at retirement. You can merge your EU state pensions, start early, and reduce your risk into retirement. Now, before we jump into the Q&A session, I do see quite a few questions that I have yet to answer. I do want to, again, just invite everyone who's joined me here today to click on the registration link to be entitled to a complimentary financial consultation with a Blacktown advisor. So during the presentation, really, we are just going to sit down with you and understand your personal circumstances and what you're looking for, your financial goals. It doesn't have to be retirement planning. I'm assuming that if you've joined a retirement planning seminar, probably going to involve some retirement planning, and we can certainly help with that. So we'll be able to help you with any gaps in your pensions, provide risk analysis, help you clarify your objectives and goals, and this is done completely free of charge. Step 1 and step 2 and step 3, which I'm about to show you, all free of charge to everyone who clicks that link. Once we've established your goals and your present circumstances, we will then identify any shortfalls or risks to achieving those goals. Remember, that is just a retirement shortfall that we've been talking about today. We will then outline an investment strategy, or any strategy really, to help you achieve those goals, and potentially review or improve any existing retirement schemes or existing investment schemes or schemes in general to help you. We'll help you monitor and transfer any frozen arrangements and also explore international and local solutions. Just a note about Blacktown, we don't have our own funds, we don't have our own products. We search the markets to find the best products which fit you as an individual, and we really tailor our recommendations around what you as an individual need. Now, all of this service is done for you at no cost. It's only should you accept the recommendation and decide that you want to go ahead and become a client of Blacktown, that you would be liable for fees, which would always be made incredibly clear through the investment report. Once you become a client, we can provide ongoing advice and guidance to the length of the policy. All my clients are entitled to quarterly reviews a year, 4 quarterly reviews a year. You'll have online access to your portfolio and account because all of the services, all of the products and other providers we recommend will have online access. And we'll help you with all the paperwork, etc. And should you leave the country, we are a truly global company who specialize in expats. So we'll always be able to provide you continued service after relocation. So, any questions? In fact, if anyone wants to connect with me, that's an old Luke Staben Webinars icon. I should change that. You can find me on LinkedIn and Facebook. I am millennial, but I am apparently quite boomer in where I advertise myself. I will not be brought forward into the new century of kicking and screaming. But yes, if you can find me on LinkedIn or Facebook, please do add me, or at least find me on Facebook groups. And that way you can be kept in touch with all my new events and future events. Also, if anyone wants to invite their friends to the next events, that would be a massive benefit to me. You don't get anything from it, but it really helps me. And if you've enjoyed the presentation, I really encourage you to do it. So I'm gonna have a glass of water and let's start going through these Q&As. Okay, we've got some okay, so I've got a question which I really like this question, and I know I'm not just saying that. So the first question is, with my mortgage rate being so low, does it make sense to even pay off the mortgage or invest in the markets and assume risk? Well, this entirely depends on your risk profile, but here's something to think about. With inflation being what it's being, if your mortgage is less than 2%, is less than 5% last year, the amount of money in real terms, in real purchasing terms, that you owe on your mortgage has fallen because inflation has reduced the value. So if inflation carries on being high, it kind of makes sense not to pay off the mortgage just from that perspective. If you have a fixed rate mortgage and the mortgage interest rate is unlikely to change, then that is certainly something you can consider. I'm not going to give you a definitive yes or no on this because I don't know your circumstances, and me giving financial advice on this much information would be extremely irresponsible, and that's not what I'm about. But I'm not saying it's not something you can do. Would I wait for a market correction to begin investment at this point in time with Fed's expected to increase rates? I'm going to be honest with you. I don't think when the Fed increases the rates that we're going to see a market correction. I know that's what everyone says, but everyone expects it. It's probably fairly priced in. I think the time that we'd like to see a correction is when the Federal Reserve starts reducing its balance sheet, so it starts, calling in some of these loans that it's made through quantitative easing. I always say that time in the market is better than timing the market, and what I mean by this is that I suppose a great example of this. It's not going to make me look good, but it's true. In late 2016, when I was a stockbroker, I took my money out of the market because I very, very naively said, we've had the longest run of growth that we've had for however many years. And I think that's going to come to an end. And obviously I was wrong. And I then sat on the sidelines and saw the market grow and grow and grow over 2 years before I put the money back in. And it's been growing ever since. So trying to essentially time yourself into the market because you think there's going to be a correction is a fool's errand. If there is a correction, then I might look a bit silly. But there's what's the joke? Market analysts have predicted 30 of the last 3 recessions. Everyone's always predicting a recession or a market crash, and occasionally they get it right, but most often they don't. I wouldn't start. I wouldn't put off investment because you could be waiting years. It could work out for you, and then you feel very lucky. But I've had people tell me for the last 4 years, every year I have at least 10, 20 people tell me, I'm going to wait till next year when the market crashes, and then it doesn't happen. The truth is, no one can really predict what's going to happen in the market. If someone can, they'll be very quiet and they'll make a ridiculous amount of money off of it. So I've got a question, which is, am I a fiduciary? Well, a fiduciary is a very American term, which means that we have a requirement to do what's best for our clients. In the EU, it's not quite the same. It's not that we don't. Sorry, we do have the requirement to do what's best for our clients, but the notification of fiduciary doesn't really exist here. But we do what's best for our clients is probably the best way to answer it. We're a lot more regulated, well, by and large. Would the recording of this session be available? 100% yes. Once I've uploaded it to YouTube, I'll send it to Expat Republic and you guys can see the recording. Could you give out samples for international schemes? Well, here's the thing about an international scheme. It's anything which isn't tax relief. I don't know if I explained it the best way, but when we talk about international investment schemes, that's just a platform where you can hold your money and invest it into the market. It could be a brokerage, it could be an online trading platform, it could be a portfolio bond, which doesn't have tax relief. Although portfolio bonds tend to be tax relief, but you have to wrap them in trust. So a lot of these questions that I'm seeing, I really can't answer just because they're very personal, specific questions. Like, I'm moving back to the USA in 30 years. What should I do in regards to my pensions? because of the nature of how I work as a financial advisor, it's completely irresponsible for me to try and give you set answers or recommendations. To do that, I need to sit down with you and have a full-on consultation, understand your circumstances, what you're looking for, and how to achieve those. So I am missing quite a few of these questions just because I don't think it's responsible for me to answer them in just a few sentences. So what about international public pensions? Can those be transferred over when retiring into a different country? Unless you're based in the EU and you're retiring in an EU country, or if you can actually retire outside the EU and merge all your EU countries, but you can't transfer over a Brazilian pension to the Netherlands. Now, just to explain why this is the case, this is because these pensions, they are a cost. They're a cost to Brazil. If Brazil owes you a pension, that's money you've paid into them for your taxes, and that's money that they have to then pay out. If you move to the Netherlands and you transfer that, there's got to be a mechanism for then the Netherlands will absorb Brazil's costs. So Brazil's got all the benefits of you paying tax over the years, and then the Netherlands now has to pay this out. So the only way that can really work is if the Netherlands goes to Brazil, here's a bill for this pension that you've just given me. But that's really hard to calculate. And there's not really many options available there. So I want to retire by the age of 57. Looking at calculations, I don't think I'll be able to arrange a monthly amount that should be in your suggestion. In this case, I am 40 years now. That's its own. So this is one of the problems with, unfortunately, starting too late. So really, again, your options here are you can reduce the level of income that you want in retirement. You can try and retire later, or you can do what you can do now and hope that circumstances improve in the future, that you can invest more. I'm sorry, I don't really just. The thing is, the one thing I would mention though is that these figures are all based off not relying on government pension schemes. Now, you will have government pension schemes which will make this easier to retire on the monthly date. So you will have, for example, your Dutch state pension, which will pay out. So the situation may not be as dire as you think, but really that this whole retirement plan is a personal private retirement plan, which hasn't included your state pensions. And also it doesn't include, it may not include certain other assets which are coming in. Why should I invest my money in a pension fund instead of just buying the S&P 500? Great answer. I don't see why not. Remember, I recommend a lot of people look towards international investment plans where you can really invest whatever you want. Buying S&P 500 ETFs, that in my mind, this is just pretty good pension fund. On average, it's going to return you 10% a year over the long term, with de-risk before you get to retirement. But this is one of the many different funds that you can put into your retirement plan. That's another problem with company pensions. They're so restrictive, you don't get access to these things. But what is a pension fund? A pension itself is a wrapper which stops you getting taxed. And depending on how flexible your pension is, you can put all sorts of different funds inside that wrapper in terms to get a good return. But I recommend an S&P 500 ETF. I recommended one 2 weeks ago to one of my newest clients. S&P 500 ETF is a fantastic fund to be investing in long term. Would diversify across other funds as well. I don't think you should just have all of your eggs in one basket. But there's no reason that you shouldn't do that. How could you calculate purchase property into the retirement plan? For example, selling a house in the Netherlands and retire to another EU country. Well, you can do this a number of different ways. So I know this isn't what you gave, but if you're purchasing a property, you can reduce your monthly income, or yearly income that you require, because you're no longer paying rent if you plan on living in that. If you are planning on selling that property and moving to another EU country, well, then what you should probably do is figure out a benchmark rate of return on that property, work out when you want to sell that. So for example, if you're in the Netherlands and you've got a house, you plan on selling it in 10 years and you benchmark a rate. And now I know everyone like myself in the Netherlands knows that the property market is crazy right now. It may not continue like this forever. So let's not benchmark 50% return a year. Let's benchmark, let's say 10 or 7. And you plan on selling it in 10 years. Well, then you would compound the value of your house now at that rate of return, whether it's 10, 50, 7%, whatever you like for 10 years. When you get to the sell date, find out what it's worth then. You can take out, all of the appropriate fees, which you have to pay in terms of like real estate agent fees, etc. I haven't sold a property yet as an individual. I'm more equity based, so I'm not that familiar, which is really embarrassing. And then once you've got that big block of money, well, hopefully you're not just going to leave that in cash, and you can then start investing that into funds, establish a new benchmark rate of return, and then just add that into the rest of your retirement portfolio. In fact, if you just use 7% as a benchmark rate of return, that's really easy, because if you're using that benchmark rate of return, which is the same for your house and the same as your investment funds, you can just add the value of your property to your current assets on retirement. It gets a little bit more confusing, but it's very manageable. Does it make sense to transfer money currently invested in another country, which is a different currency, which would incur a reduction due to currency exchange? Kind of got a feeling you're talking about investments in Turkey, but that's just me guessing. Listen, if that money is invested into global companies or global funds, then the exchange rate risk isn't really changed too much. If you are holding cash in another country's currency, well, it depends how much that cash is, because on one hand, you could look at that as that's a risk, because if the exchange rate goes against me, I lose out, and that money is going to be less valuable in the future. Another way of looking at that type of investment is that I'm creating diversification. So I'm spreading out risk across multiple currencies. Now, we're all based in Europe, and euro is a fairly strong currency. But if you've got money in Swiss francs, that's never really a bad deal to have. If you've got money in the Turkish lira, then that's a bit scary. That's another question. So yeah, it comes down to managing your risk. I think when you get up to sizable amounts of money, it definitely doesn't hurt to have a bit spread in different countries. I've got money spread across multiple different currencies for my own personal circumstances. Mainly because I live in Europe and my family's in the UK, so it's nice to have sterling when I go back. But also because you are de-risking yourself, that the one currency that all your money is involved in falls apart. And plus, I had that money from the UK before Brexit, and now it's worth so much less than after Brexit. I don't have the heart to convert it back into euros. Are there any considerations to make in terms of liquidity? I always hear that buying a house is the safest investment, but as an expat, moving frequently is not really an ideal option. Are there specific assets to consider investing in towards your retirement goals? Well, as I say, I think a diversified range of investments is good. I think that in terms of property investments, the best investment you can really make from a property perspective is your first home, assuming you're not moving around a lot. And that's really because you're converting rent to a mortgage repayment. So you're converting what used to be an expense into an investment. But in terms of investing in multiple properties or properties as a way of generating income in the future, you're absolutely right when it comes to liquidity concerns. Now, for anyone who doesn't know what liquidity is, that's okay. Liquidity is just how hard it is to sell something or how easy it is to sell something. As we increase liquidity, that means it's easier to find a buyer. Now, I love stocks, and this is probably because I used to be a stockbroker, because I was brought up being taught about stocks and shares and how to trade them. But one of the many reasons I like stocks is they're very, very liquid. If you've got Amazon stocks, it's very easy to find someone else who will buy that from you at a reasonable price. Now, if you've got a house, now I know the Netherlands, houses are crazy right now. There's this huge housing shortage and anyone will take a house which is available to them. It still takes a lot longer to sell. And if you're not buying a house in a big city like Amsterdam or The Hague, even then it can be increasingly hard to find a buyer who wants to buy that house and live there. Houses innately are always going to be far less liquid. And if you need the money fast, not saying you will, but if you do, you will often have to take a significantly lower price than is fair or that you would expect or want to take. I think that in terms of liquidity, it's okay to have some illiquid investments in your retirement portfolio, and having a house having a house to live in is definitely, that's a good thing to have. But you should always have liquid investments so that if you do need to sell them fast, or you do have an unexpected need of of cash, they're there on hands. And that's why I love stocks and I love funds. What advice would I give to a 37-year-old with 12K savings to start a pension investment for the future? My advice would be to click the link in the chat to arrange consultation with a Blacktown advisor, because this is an easy layout for me. If you have disposable income, that's the best place to start. If you've got, let's say 600 a month, or any amount per month that you can start setting aside to invest on a monthly basis for a long term in a structured way, then that is going to be your main plan, or likely main plan, in terms of achieving a retirement plan. And if you're 37 and you only got if you're 37 and you're looking to start a retirement plan, it's important to I would start as soon as possible. And I would look towards, if you don't have any disposable income, maybe trying to reduce your spending habits, seeing if you can do that for 6 months before committing to a regular savings plan, and then look towards saving on a regular basis. Can I explain a little bit more about tax relief in the Netherlands? Of course I can. There's barely any. It's really just pensions. The thing about tax relief in the Netherlands is the easiest way to get tax relief from a financial advisor's perspective, from most people's perspective, is to wrap it in a trust. A trust is like is essentially a legal tax wrapper where you don't technically own what's inside it, but when you take it out the trust, you will be the beneficiary. The Dutch don't recognize trust. The Dutch law doesn't recognize trusts. So that's one of our major tools to reduce tax gone. If I knew a way of reducing tax in the Netherlands, I would be talking about it a lot more. But really, it's just pensions. And the problem with Dutch pensions is they're so inflexible. The fact that you have to have an annuity at the end of it, so you have to have yearly or monthly income, which are calculated off interest rates, which are so low, so you're getting a terrible deal as it is, and you can't take money out when you want. That I just don't think that they're really, well, specifically for me, they're not worth it. They could definitely be worth it for other people who want that security and that long-term predictability. But at current annuity rates, it just doesn't make sense. What age should we start retirement planning? I started retirement planning when I was 25. So I always say as soon as you can. The best time to start retirement planning is yesterday. I would definitely recommend, if you're above 40 years old and you haven't started already, to start now. And just click that link. Even if you don't go ahead with what we're offering, it would be good to have a consultation and for you to understand the sort of steps that you are likely to need to take in order to achieve the retirement that you expect. Can you be able to give an idea of what the involved costs for Blacktown to advise are? Yes, certainly. It depends on the product, really. But for me, for investments above 100,000 euros as a lump sum, I charge 1% to manage the portfolio and 2% to give the advice. Of course, those costs only apply should you accept the advice itself. In terms of regular savings plans, that is structured and normally works out to around 1% a year to the advisor. Yeah, but again, those aren't set costs, because really what it depends on is the level of work that the advisor has to go to. If we look at, for example, the case of moving UK pensions into Europe, that is a bit more complicated and has a bit more tax advantages to it. So we do charge a little bit more for the cost of going through all of the forms, filling out all of the numerous forms the UK government makes you fill out. I'm just getting flashbacks to all of the admin I've had to do over the last few years. But if it's just a straight investment recommendation, the costs are fairly low. Mentioning you don't have costs, you search and find one from an existing company. What types of transparency and fees can we expect? Are those fees included when calculating our target pension amount? Well, the target pension amount is when you start calculating how much you need to return a year, it tends to be net of fees. The thing is, every advisor does it slightly different. So it's hard for me to give an answer to that part. But in terms of transparency of fees, when we give you the advice report, all of the fees that you will pay throughout the length of the policy are clearly and very, very clearly identified. Otherwise, it's illegal. The reason I moved to Blacktown as a financial advisor is because Blacktown, in my mind, is the company or the financial advice company, specifically within the expat market at least, which has the highest levels of integrity. I like working for a company that I can feel proud to work for, and Blacktown has that in spades. I've never been asked to promote certain products. I've always had full control over what I recommend, how I recommend. That's not entirely true. There is a compliance department to make sure what I'm recommending is suitable. So for example, if I came up to you and I said, I want to recommend you something which is completely unsuitable, I would have a compliance department stop me. I've never had anyone pressure me to invest in a certain way. That's in fact why I've left previous companies, because when that happens, that's a terrible thing to happen. Our focus is always on doing what's best for the client. I have a pension fund in Australia for 10 years. I'm thinking about taking out the pension. I will have to pay. I'm thinking about taking. I'll pay tax for that. If I leave it until I'm retirement, I don't have to pay tax. Australian citizen, so I'm worried. I probably shouldn't have answered this question. Actually, this is a very specific, personal question. I would say that I'll ask you why you'd be worried about leaving it in Australia for so many years. I suppose my first question would be not where it is, but what funds were invested in. If it's invested in good funds, like for example, someone mentioned earlier, it could be invested in an S&P 500 ETF. That's not really something to worry about, so long as it's a ring-fenced company which has good client security. But if it's invested in terrible funds which aren't going to grow for 10 years, then maybe you should look at taking it out. That is, again, a very personal question, which I can't really give you an answer on. But again, recommend you click that link and arrange a meeting with an advisor. What is my take on cryptocurrency investments as a form of diversifying investments towards retirement? I'll be very honest with you guys. I invested in cryptocurrency 10 years ago. I took all my money out a few years ago because it's a completely unregulated market. Okay. It's first, just from an ethical perspective, I would never invest in cryptocurrency again because of the damage it does to the environment. Cryptocurrency production basically does more carbon emissions than various different countries across the globe, but it's also an incredibly unregulated market. There's pump and dump schemes where a load of people push up the price in order to get a lot of hype and everyone to invest in as much as possible, and then pull the rug out at the top and sell at high prices and leave people holding worthless investments. I fully understand blockchain technology. I see the benefit of blockchain technology. However, I can tell you that there's probably only a few coins out there which are really good investment or really good currencies, so to speak. A lot of these are just get-rich schemes, or essentially Ponzi schemes, which provide no additional benefit other than investing in them purely because you think someone might be foolish enough to invest at a higher price later. Same goes with NFTs, which are nothing more than digital trading cards, which destroy the environment through carbon emissions. If you're in 3 rental properties, can you retire, seeing as the value of the apartments as well as the rent is likely to increase in value over the years? Yes. I mean, retirement planning is all about finding streams of income. Okay, if you have 3 retirement properties, rental properties, which you are renting out, you can use the expected rent as a rate of return in your retirement. However, I would say you probably want to add like a multiplier of maybe like 0.7 of that. You need to account for times when it's not being rented out, because you can have moments when properties aren't being filled and you're not seeing a return on that. If you're not selling that property, unless you're using equity to release mortgages, the actual value of it isn't going to affect your retirement too much because you're not going to get access to that money. But the rental income, that can definitely be used. If you are planning on selling it, then yeah, you can sell it in retirement. You can retire off that by investing in other income generating things, or you can just use that money and take from it. But then, of course, you're not using the 4% rule. If you run out of that money when you retire, you're in a bad situation. Is taking out a Dutch pension even a good idea? I don't want to say, well, taking out a Dutch private pension is certainly a lot better idea when you have high interest rates. This is because Dutch pensions have mandatory annuities, essentially. So what that means is that you have to convert them into an income for life. And the rate at which you get back, so let's say you've got 100,000 and the annuity rate is 3,000, that means you get 3,000 a year back until you die, depending on the conditions of the annuity. Now, that figure is all based off the cost of borrowing or bond yields, and they're based off interest rates. We have ridiculously low interest rates right now across, like in Europe, it's pretty much 0%. It is 0%. And if those interest rates in the next 10, 20 years rise to like 10, 20%, then those annuity rates are going to rise too. And then having a Dutch private pension is great. But what if they don't rise? Then you're forced to get a very low returning annuity, which in a lot of cases, I've seen people purchase annuities, and I've sort of looked at it and said, to get back the amount of money this cost you, you have to live for 50 years to get back the amount it costs you today. So if you account for inflation, you've got to live for what, 70 years at the age of 68? It just doesn't, the maths doesn't work out in a lot of circumstances. Although if you are doing annuities, maybe just a week before, pick up smoking so you can tell them you're a smoker so they can predict that you'll die sooner and give you a higher annuity rate. That's not advice. That's something you definitely shouldn't do. It's definitely a joke. But annuities with low interest rates are just not. Obviously, every person's situation is different, and what's not good for some people is good for other people. But certainly, in my personal belief, I would not take out a Dutch pension today because of low annuity rates and low interest rates. That may be different for you. I've got a few more questions on cryptocurrency. I'm not going to answer them. Sorry. I mean, so people ask me about if cryptocurrencies and NFTs get regulated, are these good to invest in? Cryptocurrencies, maybe if they get regulated. NFTs, what is the benefit of an NFT? It's proof of ownership, which we already have for receipts. Or whenever someone says, buy this NFT, it's a rare NFT, it's a picture of a monkey smoking a cigarette or something. What is the value to that? Why is that going to rise in value? And why wouldn't you just buy directly from the artist like a digital print or like a non-digital print? From what I see, NFTs is either used for one of two things: fooling people out of their money, or it's used for money laundering. It's just used for money laundering. So private Dutch investment accounts. So I'm not sure really what you mean by private Dutch investment accounts in terms of the difference between internet. So yeah, I mean, there's actually not qualitatively a lot of difference between an international scheme and a Dutch private investment account if there's no tax relief on it. When I talk about international scheme, that's probably not the best word to use, but it's just so you guys understand that they are internationally portable. Dutch private investment account can be an international scheme just from the basis that you can always access it internationally and you're not restricted based on where you are. So if you take out one here and you move around, then you're still good. Okay, I've kind of one sec. I think I've kind of come to my I've got one question. Q&A, can you combine EU pensions at retirement ages? But yes, Chelsea, I did miss your question. You're quite right. Okay, I'm gonna answer this one question last, and then I'm gonna go because we have run quite considerably over time. Got something I need to do in a bit. So can you combine different EU pensions at retirement age if those countries associated with this country have minimum retirement age? Oh, yes. So that's a very good question, and I'm glad you answered. From memory, okay, this could be wrong, but I'm fairly sure that you can definitely combine them, but it might just be a case of if one country has a minimum age of 67, they'll pay out that portion or a percentage of the pension you're due at 67. And then when you reach 68, you get the rest of the pension that you'd be due from other countries. And if you get to 70 and there's another pension which you'd be due from in that country, then it paid out to you. If you want information on this, on the slide in which I talked about this in the presentation, there's a link which explains everything you need to know about this. I don't actually spend too much time focusing on this just because I know as an individual advisor, I can't directly help my clients with this. I have to just point them to the link and say, this is how you do it. We can't get involved. But if you click on that link, it will explain all of these questions and have a huge FAQ, and it's a really great source of information. Okay, so just want to say thank you ever so much, everyone, for joining me. I do love these events. In case anyone wants to join the next one, we actually have one tomorrow called The Basics of Investing. We're doing that event again on Saturday. So if you want to give that a Google and show up, we will be there. I will. What I'm going to do is I'm going to turn off my camera. I'm going to turn off my mute. I'm going to mute my microphone as well. Talked a lot. And then I'm going to just leave the chat open. So if anyone has another chance to click that registration link, you all will have the opportunity to do so. So thank you ever so much and have a lovely evening. And a happy new year, everyone, because we are just still in the new year.